Hello and welcome back to the Note. We've had a calm day on world markets, a nice rebound in Asia to start the day, catching up with the rest of the world after the oil price rebounded on Monday. Then after that, both the oil price, which was firm, and earnings from US companies, which were generally better than low expectations, helped ensure that there was no great reason to sell stocks, and so stock markets were largely up for the day. Now, if we start by taking a look at the US, you can see the blue line there is the S&P. It passed the level of 2100 today for the first time since December. It's also up from where it was exactly a year ago for the first time in quite a while. If you see the sectoral breakdown of the S&P, it's very interesting. First of all, the red line there, the banks. Plainly, a lot of the sell-off earlier this year was about great fears surrounding the banks. The earnings season has suggested that those fears were overdone. The results that banks are announcing are very bad indeed, but they're not apocalyptically bad as some people had expected, so you're seeing that rebound. That's important because banks tend to lead stock markets when the financial system is in trouble. It's very difficult for stock markets to prosper. The other important sector to note, however, is technology, very much a leading sector for a lot of the last few years, and indeed at present. What we've seen in earnings season there is a number of companies that have reported so far in the tech sector have been punished very strongly for disappointing guidance on revenues. That accounts for Netflix and IBM, both of which were down very sharply today. Intel has similarly, after the market today, reported results where they were somewhat bearish about revenue prospects, and their share price is down a lot in after-hours trading. This is certainly one to watch. If there is serious weakness about revenues for the tech sector, that will make life harder for the market as a whole. However, I suspect the biggest factor underlying whether the S&P can get back to the May high from last year will be the interest rate picture. If we take a look at this chart, this is derived by Bloomberg from Fed funds futures. It shows you the implicit probability on the Fed funds market that we will see the two rate rises between now and the end of the year that the Fed has told us to expect. And as you can see, there is less than a 20% chance, according to the market, that we're going to see that. The last time a rally like this petered out, back at the turn of the year in January, or back in last summer when we were still much closer to the highs, the chance that there would be some serious tightening this year was thought to be much greater. If we continue to see markets price on the assumption that the Fed will be very dovish indeed, then that probably does mean that the S&P can get back to its high. If, as I suspect is quite likely, we see the kind of moves in unemployment and inflation that cause people to start factoring back in the possibility of serious tightening by the Fed, then that will be much harder for the stock market.